Augusta here from the new face of finance. Today I'm going to be providing COVID-19 mortgage market review for Q4 2020. So let's start off by discussing access to mortgage products in the current climate. In January of 2020, there were tons of 90% loan to value mortgage product for residential purchases, either first time buyers or people who had a portfolio but wanted to purchase a residential property. However, this market has all but disappeared, with the new norm being around 85% loan to value, an increase of 5% of the deposit that you're required to purchase your property. At present, I can think of two lenders who are offering 90% loan to value products. And of those lenders, the cheaper of them comes with a whole bunch of restrictions. Now, there was a period during the course of the year when very few mortgage transactions could take place. This happened from the lockdown period of about mid-March right up until the end of May, the start of June. And the reason why a lot of transactions were slowed down was because we were in lockdown and essentially a few things couldn't happen. Firstly, we couldn't send valuers out because the COVID risk was high and nobody wanted to risk their families by entering into a potentially COVID-riddled household to value the property. The other thing was that the courts were closed. And so, for example, it was really difficult to register properties at the land registry. And this really slowed down transactions for that 3-month period. However, the base rate is the Bank of England rate had been reduced to about 0.1%, which meant that actually when residential lending resumed around June of 2020, rates were quite competitive in the residential space. However, over the last few months, we have seen these rates start to increase with the availability of products start to decrease. Buy-to-let paints a similar picture in some respects. So at the start of the year, there were availability of 80% and even one lender offering an 85% loan to value buy-to-let product. All of these have now been stripped away, and the maximum LTV across most of the buy-to-let market is now 75%. Now, I often recommend 5-year fixed rate products, especially with buy-to-let. It's quite expensive to constantly be refinancing because a lot of buy-to-let products attract slightly higher arrangement fees. So you don't really want to be remortgaging every 2 years and adding these arrangement fees if there's no real reason to. And what are good reasons to remortgage? Switching lenders or to capital raising, I think, is one of the most important or significant reasons for switching lenders. So I think it's, if you can, and there's no need for you to pull out any money, then it's best to kind of try and fix your product or look to see if you can fix your product for a 5-year period. The other thing with 5-year fixed rate products is that not only do they give certainty of payment for a longer period of time, a lot of lenders use something called a rental calculation, and when applied, those rental calculations are more favourable when you fix that product over a 5-year period. At the start of the year, 75% loan to value products were starting from the 2s, but in a lot of the commercial space, or where borrowers were really trying to maximize borrowing with a generous rental calculation, we were looking at rates of about 3.15% onwards. As we saw this pause in the market, when these specialist lenders returned to the market, rates were quite a bit higher. And so we were seeing products from 3.6 and 3.7% onwards. And that was probably to make up for the lack of lending that had taken place over that 3-month period, and subsequently the money and opportunity that was lost as a result of the lockdown. At present, I am looking at a large portfolio refinance with a super specialist lender, and they are not willing to exceed 70% loan to value on this portfolio refinance. Now, I'm asked quite frequently, especially by people who are purchasing for the first time, how long is this mortgage process going to take? Now, I have responsibility over some portion of the mortgage process, but not all of it. So I believe as a broker, my job is done when we reach a mortgage offer. And typically, I would say on average, that takes between 3 and 4 weeks. After that, of course, it becomes the remit of the lawyers, the conveyancers, who then need to do whatever it takes to get the mortgage to completion. However, I've noticed that there's been an extension in this 3 to 4 weeks, because the time it's taken for mortgage lenders to review cases after the mortgage application has been submitted. So verify the documents to ensure that they fit, look through the information provided to ensure that they're happy, and bring about any questions that may arise as a result of their review. It's taken a lot longer. So there are lenders who at the start of the year were taking 2-3 days to review a case. They're now taking 9 days, some up to 16. So it's taking much longer to review cases, and therefore, consequently, taking much longer to reach mortgage offer. I think this is something that many of the lenders accept is happening right now, but it's almost a necessary evil. People aren't in the offices anymore, which means that, it's not as easy for the administrators to ask the underwriters, to ask the BDMs the same questions they could just walk across the hall and ask a few months back. Many people now, many underwriters are working from home. So when you're calling up to speak to the lender, the person picking up is somewhere in their kitchen, their bedroom, their bathroom, the kids are in the background as they're trying to work. And so it's much harder to achieve the speeds that we were able to achieve at the start of the year. And that is ultimately reflected in how long it is taking to reach mortgage offers. Now let's look into the statistics, particularly relating to mortgage applications and completion statistics. So our company focuses more on the specialist ends of things, on the more complex cases. So discussing what we're doing and our numbers of completions maybe doesn't really reflect the market as a whole, especially because most people watching this would be more getting into the residential aspect of purchasing rather than buy to let or commercial on the more complex side. So I've gone and done a bit of research, which I'd like to talk about today. 2 main things I want to address. The first one is Prime Minister Boris Johnson has declared that he would like to help first-time buyers to get on the ladder. Yes, in the long term, he's planning to do what a lot of politicians say they're going to do, which is improve the planning permission process and therefore make it easier for house builders and developers to build nice properties that are suitable for first-time buyers. But in the short term, what he plans to offer are 95% loan-to-value mortgages. Now, I mentioned previously that 85% is where the market is comfortable. That's completely true, especially where no special scheme is involved. Obviously, there's a couple of special schemes out there, the shared ownership, the help to buy. And in fact, those are probably the only opportunities where you can find yourself with 95% loan to value in today's mortgage market. But he wants to introduce 95% loan to value products to first time buyers. Now, it's a lovely idea in theory, but there are a couple of flaws to this plan. I expect that what he's trying to recreate is the mortgage guarantee scheme, which was introduced around the same time as the Help to Buy scheme in the UK, but was set aside a few years back. Now, I've made a video about the mortgage guarantee scheme, and I'll link it up to this video here, so you can watch that after this if you choose to. But what I will say about that mortgage guarantee scheme was, at the end of the day, it's banks who are providing these 95% loan to value products. So they're going to need some incentive to be able to lend at that high an LTV, loan to value. And that incentive is going to be that at least the top proportion of those products are bankrolled, are supported by some kind of government scheme, so that in the event of default, they can go after the government to reclaim any or some of the lost funds. The other thing I found when I was providing advice around the mortgage guarantee scheme is that interest rates tend to be higher for 95% loan to value products. So at the moment, a 75% loan to value mortgage product, you're probably looking at less than 1.5%. If you then get into 85%, even still, 2%, unless your credit's particularly bad and then you have to go to a super specialist lender, but you probably won't exceed 2% otherwise. Typically, 95% loan to value products are offered at 4%. So that's almost double what you'd be paying if you just got a standard product. Now, there is a trade-off. I guess if you've got really good income, but you're terrible at saving, this is a decent option for you. You don't mind paying a little bit more because it means that you can own your own home. But that will be a consequence of these higher loan to value products. The second thing I wanted to mention in this segment was mortgage approvals. The think tank and website Trading Economics have noted that mortgage approvals are up. In the September of 2020, they jumped to 84,700, which is higher than the 71,000 that was forecast for that period. In fact, it is suggested that this is the highest amount of mortgage approvals since October 2007. And that was just on the cusp of the 2008 credit crunch, the last financial crisis we had before this one, I guess. It may just be that this higher rate of mortgage approvals is the backlog coming through from all the mortgage business that didn't take place during the spring of 2020. Let's talk about commercial mortgages. So commercial is one of these areas that can be hard to define. Some people will count commercial anything from buy to let onwards towards more specialist end. But when I'm talking about commercial in this context, what I'm talking about is the purchase of a unit that is going to be used for business. So a shop or some offices, something that's just going to be used for the purposes of generating income through offering a service. It was reported that in the wake of the lockdown, because people were no longer frequenting these shops like they used to, there were a number of quite renowned commercial companies that were unable to pay their commercial rents. This had an impact on the availability of mortgage products if you were looking for a commercial loan. From what I can see, commercial mortgage borrowing has all but disappeared at the moment. To be fair, it was always a precarious market, a market that was more favoured towards the already wealthy or asset-backed. But now many lenders have exited the market with no real view of when they'll be returning. The one or two lenders that are still operating in this space have heavy, rigorous underwriting and quite high rates at 6% plus per annum. So to summarise, lending continues. However, with much lower LTVs, higher rates, definitely on the buy-to-let side, rates remain competitive on the residential side, but we are likely to see increases towards the end of the year. The number of mortgage approvals may indicate that there is relative buoyancy in the market. However, over the course of the next few months, as we start to see changes in regulation, so for example, from March 2021, it will be interesting to see if the current stamp duty holiday is renewed or if it's taken away, and to see what that implication will be on the market. It will also be interesting to see what other policies and products are released into the market and how they have an impact on property purchases and mortgage approvals. Thank you for watching. If you found this video useful, please like, share, subscribe. See you on the next video.